You are listening to Keystone's Stock Talk Show, episode 277. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. Great to chat with you again this week. I will start with our star of the week, another company that should be no stranger to clients, as it's been a focus buy for years in our Canadian small cap research and part of our VIP portfolio. The company Versabank, symbol VBNK on the TSX and NASDAQ, is up over 125% over the past year, 233% since our original buy. The company is a Canadian Schedule I chartered bank and one of the world's first fully digital financial institutions. Versabank primarily makes money from point-of-sale loans and has now moved that into the U.S. market. In our Your Stock Our Take segment, Aaron kicks off the festivities with a quick look at an interesting net cash Canadian microcap Canaf investment, CAF, on the TSX Venture, which produces an alternative to regular coking coal. It is a cleaner fuel because of its high carbon content and purity versus coke. Brett answers a viewer question on Plurilock Security, symbol PLUR on the TSX Venture, a cybersecurity services provider, software vendor, and value-added reseller. We have answered questions on the show several times on this company, noting revenue growth without commensurate profitability, which has pushed Plurilock outside our investment criteria. The stock has been extremely volatile year to date, and Brett lets you know why. Last and definitely least, Brennan answers a question from a viewer on Jessica Alba, co-founded The Honest Company, symbol HNST on the NASDAQ, a personal care company dedicated to creating clean and sustainable design products. Since its IPO in 2021, the stock has been in free fall, with the company unable to generate profitability. Recently, the stock is up almost 100% since the beginning of November, driven by stronger Q3 2024 results. Brennan gives you his honest look at where the stock is today. All right, let's get to my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Doing good.
Good.
Good to hear. We still have our on-demand webinars available. Go to www.keystocks.com. So we'll get that right out of the way. Do we want to go right into our poll question for this week?
Let's take a look.
Okay, yeah. Brennan, you have that right.
So not Brennan, but Brett, yes.
I want Brennan to have it.
Yeah, I know you do. But so nice and simple question. Do you invest in international stocks just external to Canada, the US? 62% of our viewers said yes, and 38% said no. This one I think is pretty aligned with when I was looking it up with the broader market. I don't think we were overly skewed like we are sometimes. The one thing which I want to get really mentioned on this is a lot of investors do tend to have what's called a home bias. So you invest more in domestic stocks than what you otherwise should, because you do get some diversification benefit from looking abroad. But that does sometimes come with other risks. You end up with currency risk, you end up with different regulatory risks and so on like that, as well as just being harder to access. Some brokers just won't have access to externally listed stocks. But if you are able to invest in the US market on US exchanges, most of the time you can actually gain access to many international stocks. So Chinese company Alibaba, right on the NASDAQ or New York, can't remember which one, but you can buy it through American markets, and you don't need actually direct access to either Shanghai or Hong Kong. But yeah, I don't know if you guys have any thoughts on that.
Yeah, I mean, you can also gain exposure internationally through many listed companies on Toronto, and even far more in the US.
Yeah.
So
and like that's what I was going to say
how
too.
I'll gain exposure.
Because like that's the thing. Like I did answer no.
But exactly like Ryan said, like, I mean, I've got like, obviously several names in mind from our own research. And, there's one that comes to mind. They recently acquired basically a company in Europe that is providing, training like simulations to, NATO countries essentially. So, like they're getting exposure that way. Like, again, like there's tons of companies that we have that have international exposure. So, while the question, like you were saying, Brett, asks specifically, are you investing in international stocks? Well, no, I'm not, but I do have exposure to the world generally.
Yeah, that's another factor is like how you define international stocks can be loose. I just left it up to the voters to decide what they consider.
The number was 62, especially since you're indicating there that U.S. is not considered international here, right? Like this is outside of North America, U.S., Canada, North America. So I'm surprised. I'd be interested to know how most of these people are invested internationally, if they're doing that through some type of an ETF or if they're doing that through individual stocks on foreign exchanges. But in terms of
maybe that's the next week's question. How, it's too
full
bad
survey.
that we can't. Yeah, it's too bad we can't like actually like survey or like have like where like you put in other and then they can like type in their own actual answer, so we really get an idea. But I agree, Aaron. That's an interesting, because it also surprises me. I would have expected no to be at 60% or something like that.
Yeah. But just on the topic of home bias, that's actually one of the segments of our webinar that we just did is just focusing on, what the U.S. investment opportunity looks like for Canadians, whether or not Canadians should hold U.S. stocks or equity investments, and what percentage they should generally be of someone's portfolio. We discuss those things. And, really we look at some of the structural differences between the Canadian and the U.S. markets that are really the reasons why the U.S. market over time has outperformed the Canadian market by such a large degree, and why it may be positioned to continue to do that in the future.
Yeah, I mean, it's a real eye opener to see the difference between in terms of breadth of companies that you can find in the Canadian market. Well, the U.S. market is higher breadth, obviously, but it is a real eye opener when you look at, especially on the tech side of things, where there's just a real lack of really, amount of tech companies, but just quality.
As a tech sector, I mean, we have some, but it's quite small by comparison relative to even our size, relative to even the size proportionally of the Canadian market. So,
yeah, for sure. Now, do we want to quickly touch on some of the Trump appointments, or maybe a quasi appointment? The project will be called the Department of Government Efficiency, and that it's supposed to be funny. The acronym for Doge is the ticker symbol for Elon's favorite meme coin, and that'll be Elon, and it's Vivek
Ramaswamy.
Yeah. Does anybody want to comment on that?
I just don't think that there's really much to say at this point until there's something to actually say, and we actually see what happens. I mean, there's all sorts of different ways these appointments could play out, but it's just like right now, I mean, we're not there yet. Since it's not really a political commentary show, I don't really want to get too much into the politics of it. I'd rather just talk about the economics and the investment perspective of it. But obviously, I think everybody can agree efficient government is a good thing. But to the extent that, they're going to be able to go in there and make changes, it's difficult to say. And then also making sweeping changes without really thinking about the repercussions isn't necessarily the best way to go about it either, because a lot of people depend on the services that are provided. So yeah, I don't know. For me, I just want to see what actual news concrete comes out and just assess it from there.
Yeah. And Musk came in, bought Twitter, now X, and made sweeping cuts there. And, you can agree or disagree with what he did, but you can see how the product is right now. It's different, certainly X or Twitter, from what it was 3-4 years ago. For me, I mean, there's probably more free speech on there, probably is. But for me, like, when I look at a thread, I used to look at, stock twits kind of on there, like fin twit. It would all be related to that post. Now it is, littered with garbage that's not related to that post. And the same thing when I looked at just, a hockey trade or something, everything would be, but there's maybe every fifth post is related to that. So, I mean, there's probably some good and bad, but it certainly is harder to use. So, and I think the other thing about, this Doge is, like, they're certainly not the first people to try to streamline government. I would love it if they could streamline government in an effective way. But I mean, the Congressional Budget Office has long-standing list of options for reducing the deficit. If you look, Congress just routinely ignores all these things in the US. So will they come out with some great suggestions? Potentially they come out with some great suggestions. Will they be ignored? I mean, a lot of politicians, you're cutting bureaucrats that are their friends in many cases, and you might be cutting funding to politicians. So it's great to saber rattle and say that you want cuts in government. Will it actually happen? Maybe they'll come up with some great ideas, and we'll have some cuts in their government. Maybe that'll trickle over to Canada, and we can have that too. But call me skeptical until it happens, and until we actually see meaningful cuts, and some people actually, being held to account in terms of where their spending is. There's been recommendations for years and years and years, and they haven't been taken seriously. Maybe they'll get more publicity with somebody like Elon, who tends to make things very public.
Well, he was part of that, I don't know, round table thing in Trump's first term, which I think fizzled out within the first year, and it was industry leaders and quickly fell apart from there because nothing really got done. So if you want to add some further skepticism, there you go.
I would say a preview to our prediction show this year would be one of my predictions would be, but after 4 years, I would say that, like, both Donald Trump and Elon Musk are very volatile people. I would say at one time there will be a fight between those two, and it may end very differently than people think. It may not be this happy marriage through the whole term, or maybe they can get along. I don't know. But there might be a prediction coming in that show that says at some point there would be a falling out between two very outspoken people that definitely have strong opinions. And that happens a lot.
Mm-hmm. Yeah. Like, this is kind of a tangent, but like, speaking about fighting, Jake Paul and Mike Tyson fought this weekend. And to be honest, I thought that like, we're recording
Brennan
on
thought
Monday.
It was the greatest fight he'd ever seen.
To be honest, I didn't watch it, or like, I tried to watch it, but I was out downtown with friends. Anyways,
Living
I mean,
your
they
life.
didn't have it on at the place that we were at. But what I was going to say is I thought Netflix's stock was going to maybe be down today just because of like the whole, like, I saw, over everywhere online, basically everyone talking about that, like the buffering of Netflix. No one could watch it. I mean, Ryan and Aaron said that they were able to watch it fine.
I watched it not live though.
You didn't? Okay.
Well, that's because we're not on our parents' Netflix. So I'm just kidding.
So everyone in the world is on there?
I'm kidding. I'm not saying you are, but 90%.
Well, I mean, I wasn't even on my own Netflix.
Apparently not everyone is, because
bar.
Netflix is actually doing quite well, and one of the only streaming companies that can generate, consistent cash flow. And they add, I mean, at their size, I mean, I looked at a chart of them over the weekend compared to some of the other streaming services, and Netflix actually, I think in the last quarter was up 12-13% in terms of ads of subscribers, where most, other than very recently launched streaming services, were down. Even the big ones like Disney Plus, subscriber count down. So Netflix is doing something right.
Mm-hmm. But anyways, I thought that was interesting. I was expecting, to see Monday the stock down, and I mean, obviously that's all like anecdotal and just like, sentiment. So like, it doesn't mean anything towards the business, but that's just what I thought. Anyways,
it did to you were right. It dropped in the morning, then it ended the day up.
But even when it was down,
it was
3%.
Very slight.
Old news by halfway through the day, right? So we moved on from that.
Exactly. The news cycle's so quick.
Yeah, it is. It is. Okay, well, we might as well get right into the show. All right, our star of the week. Again, this stock should be no stranger to Keystone's Canadian small cap growth stock clients and VIP clients, as it's been a focus buy recommendation for several years. And it's posted tremendous growth in terms of share price and revenues and earnings over the past year. Well, it's Versabank, symbol VBNK on the TSX, is a Canadian Schedule One chartered bank and one of the world's first fully digital financial institutions. The company primarily today makes money from point of sale loans, highly successful doing so in Canada. And now they've moved that model into the US market. Let's look at that star performance. This is the stock, how it's performed very well over the past year, up 123%. Since our original recommendation in the $7 range, up 233%, driven by strong results in its core Canadian market. But it's the potential of the company's recent move into the US market that is driving current optimism for the stock. Let's give you an expanded version of what Versabank does. Today, Versabank primarily makes money from point of sale loans. If you need a loan to buy a motorcycle or a hot tub, for example, you're in luck. The vendor you purchase from may run your credit card and offer you a loan on the spot. That loan isn't coming you from, say, Ted's motorcycle shop. It's coming from a bank like Versabank. In fact, the majority of Versabank's growth these days is from point of sale loans for, say, high-vac replacements, something that often costs between $12,000 and $20,000. Those are significant sized loans. Versabank has pioneered the technology to make these kinds of loans easy to offer through merchants. Versabank structures their loans in a way that gives them way less risk than a typical lending bank. Their average provision for credit loan losses as a percentage of average loans is incredibly low, 0.01%. That's to say there are virtually no credit losses on their loans. How do they manage that? It's the way they structure their point of sale agreements. It's a little more complicated than this, but if a loan goes unpaid for 90 days and falls into arrears, the point of sales partner repurchases the loan and reimburses Versabank. This way, Versabank is not responsible for collections. In other words, merchants are the ones that end up with collections and defaulted loans, not the bank. Let's quickly look at the valuations where they are today. Despite the surge in its share price, the valuations remain not overtly stretched, particularly if the company can deliver on its expansion potential in the US market. But this may take time, but we can see here, based on their estimate for this year, around 13.7 times, their estimate for next year, if they can grow at the rate that they are hoping at, again, 9.78 times. Let's look at a quick conclusion here. Well, historically, they have operated only in the Canadian market, been highly successful, increasing revenue over the past 2 years, around 134%. They've been the fastest growing bank in Canada on an EPS basis. They'd be undervalued historically, just based on those Canadian assets alone. They have been over the past year. The US market entrants recently acquired an American bank, which will give them access to offer point of sale loans to the US consumer. The US market, as we know, is 10 times larger than the Canadian market, and the appetite for credit and point of sale loans is even greater. So the opportunity is potentially greater than 10x down there. Point of sale lending generally in North America is on the rise and becoming extremely popular with both consumers and merchants. Everybody wants their purchases right away, not to wait. Versabank's point of sale solution is new to the US market. It's a new mousetrap and has the potential to grab the market's attention. Versabank also, we'd say, has high operating leverage, meaning profitability increases significantly the more point of sale business the company does without the need for much additional capital. Near term, the US expansion and the weakness in its core Canadian market will likely they'll probably drag on earnings. Clients will be updated over the next week on the stock, but Versabank's 123% gain over the past year, 212% approximate gain since our buy recommendation, make the company our star of the week.
Yeah. And we were really pounding the table for clients to buy Versabank. I guess this was back when it was trading at around $10. The previous fiscal year, they had some tough taxation essentially, which we kind of knew was going to lead to easier comparable results for the following year. I believe it was 2023, which was good. So, we found this opportunity to buy the stock. We knew, Dave's plan, or David, We knew their plan, going forward, and eventually they came out, made this acquisition in the U.S. It took a heck of a long time for them to close that acquisition, because this was, right around the time essentially when there was a lot of investors were scared, because we saw, the Silicon Valley Bank, and basically all the regional banking stuff that was going on in the U.S. So there was definitely some negative sentiment in the near term, but again, long term, we saw the opportunity there, and like Ryan said, great operational leverage, as they continue to grow. So yeah.
Yeah, and the company's posted just strong EPS growth over the past year and
Yep.
this year, and maybe they take a pause in the near term as they expand into the U.S. market. There's some additional costs coming there, but if they can be successful, start to announce some partner agreements in the U.S. market, the potential for long-term growth is there. And again, our clients will be updated on the company, but it certainly is one of our stars, as it's up about 123% just over the past year. All right, we can move on to a unique Canadian microcap, Canaf Investments, CAF, on the TSX Venture. And Aaron's going to look at this company, and he's going to hopefully understand how to pronounce some of the devolatilized erythrocyte.
Okay. Let's just get into it here. Okay, excellent. Yes, so we're going to take a look at Canaf Investments. So we received an email question from one of our viewers. Alex asked, would love to hear your opinions of this company. They have nearly half of their market cap in cash, no debt, and have been growing earnings at a 31% annual rate. So happy to take a look at this. Looks like some interesting numbers that we can dig into there. Canaf Investments Inc. symbol is CAF on the Venture Exchange. It's a small company, $15 million market cap company, trading at 32 cents per share. And what do? They're a Canadian company. They primarily operate in South Africa, focused on processing anthracite coal into high carbon, devolatilized product called calcined anthracite. This specialized coal product is sold mainly to steel and ferromanganese manufacturers as a substitute for coke. And yes, I did have to look up the pronunciation of several of these words on YouTube beforehand. Okay, so looking at the company's share price, very strong performance here in 2024. The share price has doubled. So couple things that the listener Alex mentioned about the company that I want to look at first before we dig further and just make sure if this is accurate information. So one of the things he said was that they have about half of their market cap in cash. Let's take a look. The company does have 7.3 million in cash, and it has zero debt. So that works out to net cash per share of 15 cents approximately, and that is approximately 50% of the company's current market cap. The share price is 34 cents right now. He also mentioned that over the past 3 years, earnings have grown at a rate of 31% per year. So when I look at the company's annual results here, going back 10 years, if I were to calculate the 3-year compound annual growth rate of earnings, basically almost exactly right. Again, it's 34%. But there is something that I want to kind of point out here in this chart, and that's that, the vast majority, nearly all of that growth, as a matter of fact, just occurred in the last year, 2023. If you take this year out, you can see, a very different picture where, there has been reasonably good earnings over the previous couple of years, but really a lot of volatility over time. So big move up in growth in 2023. What drove this was basically an increase in output or production or sales of in terms of the number of tons, but then also better pricing. And this was appeared to be the result of higher demand. But this is a situation where, you have a very commodity sensitive company. And we should expect that we're going to see volatility in the financial performance going forward, and not just this consistent growth of 31% compound per year, which is really kind of an illusion here, given that all of this growth, or nearly all of it, was just focused on one single year. Now, to put this into perspective, if we look at the 9-month earnings, they're actually flat in 2024. The company had a decent Q3, but a weaker Q2. And I'm going to get into the outlook a little bit later as well. One of the things that the company announced is that they are expanding into new business ventures. One of these is essentially to provide short-term asset-backed financing for businesses in South Africa. So they made this announcement on September 26th. They're partnering with an organization called Alternative Finance Group, and essentially they're just going to provide capital to different business ventures in the region. They're targeting allocating 1.9 million by January 31st of 2025, and then they're targeting returns of up to 2.25% monthly. So that would be solid returns on an annualized basis. What they really are looking at doing here is diversifying their portfolio outside of just coal production and into other industries within the South African market. Now, taking a look at valuation here, so just based on the current share price, 6 cents in trailing earnings per share approximately, you're looking at a valuation multiple of about 5.6 times on a price to earnings basis and 3.2 on an EV to earnings basis. So the difference EV, this is just taking out the net cash. So share price minus the net cash divided by the earnings per share. So certainly you are looking at a low valuation here and a pretty impressive net cash balance on the balance sheet. But let's take a look here at the company's outlook to just get some more perspective. They're actually forecasting a 15% decrease in sales for Q4 2024 relative to Q3. And this is due to customers reducing demand caused by high stock levels and lower production rates. So we saw that big uptick in performance in 2023 due to increased demand, and now it seems that has softened. So we're basically getting flat performance in 2024, and really we don't know where prices or production are going to head in 2025. So there's a lot of uncertainty there. Management does acknowledge that they are very dependent on commodity prices, which can fluctuate significantly, and that's going to directly impact their own business. So what they're doing, because they have this huge cash balance, is they're focusing on strategic diversification, and that's looking at opportunities outside of the coal industry. So I'd already mentioned the opportunity to provide financing for different projects in South Africa. That's an expansion into financial services, but they also announced that they are investing capital into rental properties in South Africa and expecting to get high returns from that. So personally, I actually don't like this. I don't like the idea of a company that is not focused on one business segment. For example, providing financing to different projects, that may be very profitable, but this is well outside of their area of expertise, it seems, which would be managing the coal facilities. The market likes companies that are focused on a business segment and management teams that will do things that they do well. By basically breaking your company up and being part rental property company, part coal producer, part financing company, it makes it harder for investors to understand. It adds more uncertainties. You don't really know much about the individual investments the company is making. So the market really likes companies that are focused on one segment. And if you're not, you're generally never going to get a good valuation unless something, that you do outside of that just really hits and takes off. But that would be speculative to just assume that. So the fact that they're feeling the need to invest outside of coal really shows you that there aren't any investment opportunities, presumably still in the coal space. And now you're looking at a situation where it looks like demand is leveled off. Maybe it's going to start to come down as we go into 2025 here. So we wouldn't be buyers. It's a tiny company. Yes, the valuation looks good. The net cash balance looks good. But it's based on kind of how they're managing the company, it's not going in the direction that we would want to see. If they were saying, there's great opportunities to invest more in what we do, and we're going to take this net cash that we have and expand more upon what we're already doing and have done successfully, then I would be more interested, but not if they're going to be so unfocused into a number of different business segments. So I think it trades at a low valuation. And I don't see really many pathways for that to change in the future.
Yeah. Like one thing too that I noticed is just, like its median trailing PE multiple is like 4.5 times over the last 5 years, and like a lot of the times we'll see it, get up to, about like 6 times kind of. I mean, that's at least what I saw in, 2022 2022 it shows, and kind of 2021. But generally, like right now, it's trading above its historical, PE multiple on what Aaron showed. So, that's something else to keep in mind.
Yeah, and I would agree on the focusing on kind of what you do best. It's typically what we like to see, particularly in a smaller company. Like this company, they don't have a tremendous amount of size to begin with in the segment they're in, and they're already, I get that there's excess cash probably coming into the company, but like Aaron said, that means they don't have anything to invest in their core competencies. So, or there is, like, they're not going to get a multiple that's significant when they're in the coal industry. They're not a producer, but processor does not get a high multiple. But they, and
they're not as
they went into the they went into the real estate sector, I think, in 2019, I believe. And that's still, I mean, they bought some properties, but it's still a very minor percentage of their overall revenue. And now they're going into another financing. So it shows me right now that the real estate, like the REIT type structure that they're trying to do there, is not really working. If it did, why don't we just keep doing that and generate more capital and return doing that? They're going into another financing business. Perhaps that's more successful, but even just only targeting 1.9 million, that's not a lot of capital in the finance business, really, to generate a significant return on that, even at the return level that they're talking about there. So, I mean, we would just focus on the core business. I guess it's unique in that nobody wants to invest. Hardly, it's not nobody, but a lot of the market doesn't want to invest. They could consider it a sin stock. That doesn't mean I do, but the market and sentiment considers it that because of what you're producing there, even though it is, more efficient, less harmful emissions being produced. It still is, you put that versus some type of the cleaner energy projects, and it gets a low multiple. Will it get a higher multiple going forward? Unlikely. So you're fighting against that, and then you're fighting against now three sort of different businesses here. And is there a focus? We'd like to see the focus. It's not a horrible company. It's generating cash. There's tons of cash in the bank. It has low valuations. Will it get a high multiple at any point? Likely not, but maybe, continues to increase earnings. But like Aaron said, part of it was price increasing, right? That's a pricing environment. So we'll see if that is maintained. Okay, well, unless anybody has anything different or any other take on that, we can move to Brett's take from a viewer question on Plurilock security, symbol PLUR, the TSX venture.
Yeah, so this is actually, I think, the third time I've covered it, and I think you guys might have talked about it before. I was with Keystone as well. So we've been watching the company over the years. If you're not familiar with Plurilock, symbol PLUR on the TSX venture, they are a multiple patent holding cybersecurity service provider, software vendor, and value-added reseller. They operate in highly regulated industries, including healthcare, critical infrastructure, government and defense, and financial services. The last time we covered them was in June of 2023, with the main takeaway really being at the time is revenue growth was looking a bit better, was looking positive. But to support the growth, they were diluting shareholders significantly. So let's see if that's still the case. Let's see if anything's changed, improved, got worse, so on. The stock is currently trading at 52 cents, down 20% year to date at a 30 million market cap. However, over the summer, the stock just skyrocketed to about $250 a share, but quickly came back down. Even on this chart, you can just see it's effectively a straight line over that week once it peaked out there. So very volatile stock, even if the year-to-date price change isn't that dramatic. So looking at the last quarter, Q2 2024, revenue came in at 12.6 million, 3.2% growth over the prior year. 80% of the revenue, however, comes from hardware and system sales, which is generally lower margin. 8.5% came from software licenses and maintenance sales, and 11.5% from professional services. The biggest change here is that shift up in the professional services by 98% to 1.45 million from 731,000, which is a good increase. It's a higher margin line, but it is still a small portion of the overall revenue line compared to the mass proportion of hardware and system sales. And they did note that this is something they are focusing on these higher margin activities to actually produce some sort of gross margin instead of just revenue. The company did do some cost cutting as well late last year with layoffs, resulting in lower operating costs of $3 million compared to $3.5 million. However, the company is still actually at an operating loss of $1.1 million, but that is an improvement from an operating loss of $2.1 million. So an improvement nonetheless, but it's still a loss ultimately. Further down, the company had a significant loss due to convertible debt and debt settlement, which are really one-off items that relate to the warrants attached to the convertible debt and the issues of warrants and shares to settle the debt, other type of debt. Non-cash, but they do dilute the company, which we will get into in a minute. The end result of all this is a net loss of $3.9 million or 11 cents per share. A quick look at the cash flows. The company is still burning cash, having an operating deficit of about $1.5 million, which needs to be covered by raising capital. They do not have the balance sheet to support a constant burn at this time. And they've effectively continuously done this equity raising, at least as long as I've been following the stock. The balance sheet at the end of the quarter is not great. It's not the worst thing ever. It's slight net debt of 0.1 million, but that's not really meaningful. It's break even pretty much as far as cash and debt goes. However, the company does have a poor current ratio of under 1 times at 0.76 times, which can indicate short-term strain. This is driven by the balance of receivables and payables, which they have highlighted as a risk previously. And they've actually, previously in April, they raised shares to lower the payable outstanding. So it is having an impact on their capital structure. The stock has previously gone already through a 10-for-1 consolidation, but the dilution has continued at a very rapid pace. So at the end of Q1 of this year, the company had 10.3 million shares outstanding. By the end of Q2, due to the massive share and warrant placement to cover that accounts payable or paid down a bit, by the end of Q2, the company had 43 million shares outstanding. And even since then, due to warrant exercising, the share count is nearly at 59 million shares outstanding, nearly 6 times what it was at the start of the year, which is just a massive dilution. And that is not really a sustainable business practice to keep on diluting, and it doesn't really create value for the shareholder. It subtracts it. Although the balance sheet should be looking a bit better once you see the Q3, as they have had those exercises, they should have raised cash. They should be able to pay down some payables. But this is your causes. Your shares have 1/6 the economic value what they did at the start of the year. You own a smaller percentage of the company unless you are buying additional shares. So a positive point is they've had a couple significant contracts announced recently. They do really love to announce contracts, and I think they overdo. I think they should only focus on the bigger ones. But a couple of the bigger ones, which they did sign recently, was a $19.3 million US over $3 million contract over 3 years with an undisclosed S&P 500 company to re-platform its cybersecurity operations stack. That's their highest historic contract act. So obviously, good thing to see. But it's really a one-off compared to some others. The second biggest, which they've had recently, and these would be in Q3 and Q4, is both these are in Q4. They had a larger 5.4 million Canadian contract with a law enforcement agency announced last week. So 2 larger contracts in Q4. They had a relatively slow as far as announcements go in Q3. But we will see likely those earnings in the next couple of weeks to see if they've actually been able to sustain any sort of revenue growth, as normally their Q3 and Q4 is a bit higher. They have a bit of seasonality, but it's not, since it is a contract-based business, as you can see on the slide right here, you do have lots of variable even year to year, quarter to quarter, just because of contract timing. So overall, the company's just not appealing in the time the cash flow burn has resulted and will continue to result in shareholder dilution unless that changes, and it really needs to be stop to have any sort of investment case as a long-term investor. Is you can't have constant cash burn dilution. It's just losing you value as a shareholder. The revenue growth hasn't been spectacular over the last couple of years. Yes, it's upticked and you got some higher margin, gross margin, but it's not like this spectacular growth. If you're issuing shares crazily like they have been, you need to have a high return on capital investment, which they just haven't. Q3 and Q4 are normally stronger, which could give a bit of insight into any sort of a turnaround coming. If that is the case, they are worse off than they were earlier in the year, I would say, but it's not exactly enthusiastic when you're seeing that level of dilution. The cost cutting and focus on high margins is positive, but it's just still so far off of being appealing at this time, in my opinion.
Yeah,
Certainly.
I mean, I think it's a pretty easy equation there. You have
Mhm.
some revenue growth, although even that has flattened, and you have negative cash flow for 6 straight years. And the only way to keep the business going is to continue to issue shares, diluting existing shareholders, and it just that's a recipe for a share price that's not going to go up over the long term. They have to keep cutting costs and bring in better margin. It's nice to see the professional services, which should have a better margin. They are trying to emphasize that. You got to keep doing that. But if you have to keep getting there by issuing more shares, you've already had a 10-for-1 this year. And Brett showed the increase in share count over the course of the year, just since that 10-for-1 is still, again, the same path, high dilution. So
Yeah.
well, we'll monitor the company. We keep getting questions. We have a specific criteria. We want profitability from operations, and to grow that without dilution, you need per share earnings growth. We talk about this per share cash flow growth. It's difficult to get when you don't have cash flow, and then you keep increasing the share count. Those are two things
and
don't work for us.
I don't think that's going to stop anytime soon, even if, because like as you saw, the reason why they had so much dilution since the quarter ended is because their share price did skyrocket. And this is the issue when you have those warrants outstanding. If you do get some sort of a run as a shareholder, if you're a short-term investor, it can quickly disappear because those warrants get exercised, they get sold onto the market. And they do actually have, this is off of the end of Q2, it's probably changed since then, 87.5 million total shares diluted if you fully diluted the company. So there's still even room for them to further dilute under their current structure.
Yeah. Great to hear.
And like we had a client like ask about this stock in February, and I gave them a very nice email, very long, spent some good time on it but like really, the conclusion that I gave her in February was, right now, I do not see positive trajectory with the business. What I would like to see is management be able to get scale where they reach break even. It might be very difficult given the low margins, as well as commentary that they have a path forward to increase margins higher. Until then, they will likely have to continue to issue shares, which will place pressure on the stock. And of course, that's what's happened. Like as well, I don't know if I just missed it, Brett, but like why did the stock skyrocket this summer? Like I was reading an article here, and like I don't know why it started in July, but I'm reading an article.
We can speculate, but there's a hell of a lot of promotion.
Well, yeah, and this is the thing. On August 14th, the company revealed that it had filed a patent application for its AI-driven cloud access security broker. Anyway, so all of a sudden they're like starting to talk about AI. It looks like, and then the stock had a big spike. So, anyways, I just thought that I'd throw that in there because I was just I was curious why.
It is curious. But I mean, you know what? We've had about 5 or 6, 7 companies that have tremendous gains over the course of this year as well, but they are still at those prices. That's the difference, right? Like, when you look at, when we talked about a company today, like they're, you need to be able to sustain the gains, right?
Exactly.
And it needs to be backed up by something fundamental to be able to sustain those, make a new level, and grow going forward. If it's just promotion and fluff, even that's typically hard to see a share price do that. But that's how you got that. It made no sense fundamentally.
Because I guarantee we'll get a YouTube comment that's like, but the stock was up this amount. Like even on Sona Nanotech, we got the same thing. It was like, the stock was up this amount. Well,
and now it's down 20%.
Good luck with your money.
Exactly.
Mr. Stock was up this much. Yeah. No.
Exactly. Good luck getting out at that point.
If you're a trader and love the volatility, go ahead. But as an actual long-term investment, it just doesn't work.
Anyways, I've beaten the horse dead here, but let's move on.
That's okay. Well, we want your honest opinion though on the honest company.
Well,
and honestly, did you do this because Jessica Alba was involved? Is that
no? This was actually a real question. Okay. Of course it was. So yeah, this actually came in from Michael via email, and he says, "Just wondering what you guys think about the honest company. Sounds like it might be a smart buy now. Also, thanks for the recent video. I was highly considering getting in Lucid Group, but not now after seeing your video." So that was a video that Brett did. So give yourself a pat on the back, Brett. Brett. And so yeah, the honest company here. HNST on the NASDAQ, currently trading at a price of about $7.30 and just under a $700 million market cap. And the company is a personal care company dedicated to creating clean and sustainably designed products. And its products include baby clothing, diapers, wipes, nursery bedding, products, skincare, and makeup. And like Ryan said, the company was co-founded by actress Jessica Alba and IPO'd at $16 per share in 2021, raising over $400 million. So since its IPO in 2021, the stock has really been in free fall as the company has been unable to generate any profitability. And, it really couldn't generate any positive cash flow until, 2023, which we'll look at. But recently, the stock is up almost 100% since the beginning of November, driven by the company's stronger Q3 2024 results, or they're at least trending in the right direction. So let's take a look at the financials here. So first, looking longer term, we can see that revenue has had a positive trajectory and has grown since 2019 with a compound annual growth rate of about 10%. But again, operating income, net income, and cash flow from operations have essentially all been negative with the exception of 2023, where cash flow was actually positive. But looking at the recent quarter of Q3 2024, which drove the stock price higher, revenue was up 15% to about $99.2 million and was driven by strength in baby products and its wipes portfolios. As well as they noted, tracked channel consumption for the company grew 9.3%, outperforming the comparative categories, which were down 2.4% in the same period. And consumption for the company's products at the company's largest digital customer increased about 19%. Adjusted EBITDA was positive, $7 million compared to a loss of $1 million for the same period last year. And this actually represents the company's fourth consecutive quarter of positive adjusted EBITDA. So you can see they're just starting to post positive adjusted EBITDA. But again, this is adjusted EBITDA. And net income was a gain of $165,000 compared to a loss of $8 million for the same period last year. So although the company has been losing money, it appears the profitability is at least trending in the right direction, which is good to see, but it's still pretty early here. As well, driving the stock price, the company actually increased its full year 2024 outlook for both revenue and adjusted EBITDA, increasing its revenue outlook to be in the high single-digit percentage growth, and adjusted EBITDA now up to a range of 20 to 22 million. And looking at the forward valuation using the midpoint of the adjusted EBITDA multiple or adjusted EBITDA, this places the stock at an EV to or enterprise value to EBITDA multiple of about 31 times, which is not cheap in my opinion. And on a trailing basis, it trades at about 25 times trailing cash flow. Now, looking at the balance sheet, it remains quite healthy with cash of about $53.4 million, no debt. They just have leases, and they have a net cash position of $38 million. But we can see that the company's share count has been creeping up steadily as the company struggled to generate profitability. And just an operational update here. In 2023, the company executed on a broad-based transformation initiative designed to drive growth in higher margin areas and strengthen the company's cost structure to increase margins. And this includes things like focusing resources on North America, which includes the exit of its low margin business in Europe and Asia, exiting low margin elements of the cleaning and sanitization business in 2023, executing an inventory rationalization program in 2023, redirecting resources to accelerate cost savings, etc., as well as realigning resources to reflect the prioritization of higher margin opportunities. And we can see that there's actually been some progress on margins, which is, of course, a positive if the company is going to begin to generate more meaningful profitability in the future. But just keep in mind, I'll say this in the conclusion as well, over the last 9 months of this year, adjusted EBITDA margin was only 6% or just under 7%. So still quite small. And again, that's adjusted EBITDA. So keep that in mind. Now, management noted in their most recent quarterly conference call, as we look ahead, we believe we have strengthened our foundation for future growth and expect the ongoing execution of our strategy to deliver annual revenue growth, expand profit margins, and generate strong cash flow, which also benefits from our asset-light business model. So it's nice that they're putting emphasis on wanting to generate, stronger cash flow. And they also noted that annual gross margin is expected in the range of 37 to 38% as they benefit from savings in product costs and supply chain efficiencies. So again, it's good that they're focusing on the bottom line. So to conclude here, the Honest Company is in highly competitive markets with over 60% of its revenue coming from diapers and wipes. But these are consumer staples, essentially, which are more defensive. But still, they're against behemoths in these segments. And consumer products can, sometimes be fickle with customers, depending on, tastes and preferences. Now, the company has a good track record of producing high single-digit revenue growth and is now moving more focus on increasing margins, which appears to be paying off. The stock may be a bit pricey at 30 times forward EBITDA and 25 times 12 trailing month cash flow from operations, but I see some speculative upside if management can continue to increase margins. And overall, though, it's not a bad business, in my opinion. It has potential, but it's just a little early for us, as we would like to see continued ability to massage margins higher to generate more meaningful profitability. And again, like I said previously, they only did adjusted EBITDA margins of 6% over the first 9 months of the year. So while it's good that 4 consecutive quarters of adjusted EBITDA, again, this is only adjusted EBITDA. The margins are still quite slim.
Yeah, I would say based on even forward EV to EBITDA estimates, which would be optimistic, the company trades at about 3 times the sector average. And it is a highly competitive sector. It's, our price to book, price to sales. It's above price to book significantly, price to sales above the average. So a company that, it's growing reasonably well, but it's not growing at 50% or anything like that. It's not like growing
Exactly.
30, 50%. So I think you're taking on too much risk, and the company isn't yet profitable. So you're forecasting forward that it will be profitable. And even on those estimates going forward on an adjusted basis, it's like 3 times the sector average. So you're taking on a lot of risk. And the reason there is a good balance sheet is because they're raising capital, not because of internally generated cash flow. So
exactly.
Yeah. Okay. And I think that is going to end off our show for this week. If you are watching this right now on YouTube or wherever you watch it, smash that subscribe button. If you are listening this wherever you consume your podcasts, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.